Well, thanks so much for tuning into this earnings conversation with DCM Shriram. They're a diversified business manufacturing of chlorovinyl, sugar, fertilizers, and bioseeds. They came out with what optically seemed to be a pretty strong quarter, YOY at least. Revenue from operations net of excise was up about 46% year on year. EBITDA margins stronger by about 80 basis points, YOY basis again. You could argue QOQ, they came off quite significantly, but YOY they did okay. The questions to the ED and the group CFO Amit Agarwal are centered around one, of course, how was this quarter, and two, what can the exit rate from this quarter mean for at least quarter two, if not the quarters to come. Amit, great having you. Thanks for joining me.
Thank you. Thanks, Neeraj.
So, Amit, put the quarter into perspective. I know if I look at it sequentially, it didn't look the best quarter. YOY, it looked okay. How would you look at the quarter? Would you compare it YOY? Of course, the base effect comes into play. Or was there pain and sequentially the pain was showing?
See, I think one, in our kind of business, one has to look at YOY because there is seasonality. Quarter on quarter, you will have an impact of seasonality of sugar. So it's best to look at YOY. But in some businesses, yes, I'll give you the insight as we speak. So I think the quarter overall has been good. The margins have been good. I think largely, even sequentially, the margins are good, except for vinyl, where the margins have come down. So I think that's on chlorovinyl. On sugar, if I look at sugar, the margins, even YOY, have come down. But I think the way one should look at sugar is more on yearly basis. On YOY, the reduction in margin is a function of higher costs, and the prices have really not gone up the way they should have. But I think if you look at what's going to be for the year as a whole, I think our numbers should be reasonable on PBIT levels. See, I think what is important, Neeraj, to look at how the company is looking at going forward, what the company is investing. So we are investing close to about 3,500 crores across our businesses, primarily in chemicals and in sugar business. So we are investing about 2,800 crores in chemicals, in existing capacities, as well as new capacities. And all these capacities are going to come by Q1 of next year, which is about 12 months from now. And that should really add value, both in terms of top line as well as bottom line. Now, if I talk about sugar, there we are investing close to about 600 crores into ethanol, into refining, into sugar capacity. Now, that again will come in Q3 of this year, which would mean we'll be able to cover the entire next season. And that should also augur well for this business to improve its profitability. So that's how we're looking at a quarter and going forward.
Interesting, and I'll come to that in a moment because these are fairly large numbers that would come on stream. But just before that, how is the situation looking on the ground in terms of pricing power across all your businesses, input cost pressures across these segments? And what would they mean from where you are to where you could be on the operational front in, say, quarter 3 and quarter 4?
Right. Now, if I talk of chlorovinyl, see, in our kind of products, the prices are driven by the global prices. Right. Now, in chemicals, the prices have been robust. Although going forward, I do see some decline in prices, given that there is global inflation and there is some bit of demand impact as well. So I think prices going forward will come off. We've already seen prices coming off in our vinyl business. Now, if I talk of margin in this business, see, these are energy intensive businesses. So I do expect that there will be some softening in energy prices as well. As to when that happens is yet to be seen. So therefore, there will be some margin impact going forward. Although I think they still will be at reasonable levels of around 25-30%. So that's on chlorovinyl. Now, coming to sugar, as I just mentioned to you, sugar always has a lean season in terms of its margins in Q1 as well as Q2, because that's when they do not crush, right? Q1, there's a small crushing period, but otherwise largely it doesn't. And the crushing largely happens in Q3 and Q4. And therefore, there's seasonality and margins improve in Q3 and Q4. So we should see decent margins in sugar as well. And there is this expansion happening, which should add to profitability.
I was under the opinion that a lot of sugar millers were telling me that with ethanol becoming mainstream, if not in this year, then the next year this very varied impact of seasonality will also get reduced a bit?
I frankly don't think so, right? Because sugar still, for sugar companies, sugar still will have a significant portion, right? Yes, ethanol supports. Ethanol will probably form 40-50% of total profits, but sugar still will remain, equally dominant.
Okay.
But now, important, just to add, Neeraj, here is that ethanol provides stability. Like, for example, this quarter, if my overall numbers have been low, ethanol has done well. It's only sugar, because of its cost pressures, the margins have come down.
Okay. So, can you tell me about what changes does it bring to the company's revenue texture as a result of these expansions coming on stream? We'll start off with the big one, which is revenue, because some of your capacities might come on stream, but it would be lovely to understand from you, when do they stabilize and what happens in the event of a global slowdown per se happening simultaneously as your capacities come on stream?
You see, the capacities that we are coming up with, there is good demand, right?
Okay.
And let's say, as I mentioned, that the capacities will come online by Q1 of next year. So yes, they will take some time to stabilize, maybe about 3 to 6 months. But I see that FY25, that will be the full year when we'll get the benefit. And in terms of revenue, it should add close to about anywhere between 3,000 to 3,500 crores to the top line, and close to about about 20% of that to the EBITDA.
Wow! So that you've seen that's nearly about a quarter of revenues getting added in full year of operations, if I'm wrong, slightly more than a quarter of revenues.
True, absolutely.
Okay. So and I presume, because these are just about coming on stream, the final part of the funding is not an issue. You would probably do it by internal accruals or otherwise.
So out of the total capex of about 3,500 crores, 1,000 crores approximately we've already invested. We should be raising close to about 1,000 crores this year to fund these capex. But okay, this is through internal accruals.
Largely through internal accruals. Okay, and when you're talking about raising money, if you raise it, it'll be a debt raise and not an equity raise, I presume.
It'll be a debt raise, yes.
Okay, great. One final question, actually a couple of questions, if you will.
Sure.
Amit, one is around how do you see the demand environment shaping up Q2, Q3, Q4? And if you are generally believing that demand might get impacted, what could trigger a turnaround in that demand? Because there are a lot of moving pieces. It's almost virtually impossible to say what will happen 2 quarters down the line. So I'm sticking to the next 6 months.
See, I think it's a little difficult question to answer, given that there are so many moving parts, what's happening globally, the geopolitical tensions and things like that. But I will just stick to one point, which is most important according to my understanding, is the inflation. Given the high inflation globally and the way central banks are reacting to it in terms of increasing interest rates, I do see demand getting impacted, which would mean that there would be some stress on the margins.
Okay, so ceteris, I mean, because we don't know what will happen going ahead, but if what you are assuming turns out to be true, that there is some bit of pressure on demand, which I presume would also mean that their top line gets impacted ever so marginally, if you will. Considering that in a low demand scenario, you might not be able to increase prices and volumes get impacted. And if margins are getting impacted, could FY23 turn out to be a softer year compared to FY22?
My sense is it will be a little softer than FY22, definitely. Not very significantly, but to some extent, yes.
Got it. Well, Amit, thank you for being so candid. And thanks for giving us some flavor around how the different businesses are doing. Maybe at the end of the Q2, we'll get a better sense of how much inflationary impact has been on demand and margin. So it'll be lovely to talk to you then as well.
Sure. Pleasure, Neeraj. Thank you so much.
Thank you for being with us, viewers. Thanks for tuning in.
Right.